Welcome to Investor's Guide and Happy New Year to you and your family. Now, while it is, of course, a time to celebrate the new year with hope and with a lot of ambition, we should also spend some time on our investments. If you haven't done your tax saving yet, it's a good time to do so. Demonetization or not, you still have to save tax, you still have to make those investments. Don't worry, we have a list coming up on the show that will help you. We bring to you funds for 2017. This is our Big Bang episode, our episode where we tell you what funds you should be investing for the new year. Now, pick up a pen and paper, write down what you hear on the show. If you have any questions, you can get in touch. If you want the list emailed to you, get in touch as well. Someone from our team will do that. But first, let me bring in Dhirendra Kumar. Dhirendra, thank you so much for joining us and picking out this list for us. To begin with, it's going to be a different year. It's going to be a choppy year. We've already established that. Any advice for our investors going into 2017?
One is that, it will be post-demonetization. I think it will be a very noisier, markets are always noisy. But this will be more noisy year. And it has the potential. The scale of noise could be such. We have seen all that even in 2016. We have seen Brexit. We have seen the US presidential election and a fairly unexpected outcome. We have seen demonetization. We have seen all kinds of things. We were also, anticipating the rising, the hike in interest rate in the US, and all that happened without much of a, of course it would have had an impact, but not of a kind, the kind of calamity which was predicted. So I would say that, investors should keep calm and have a plan, and they should carry on. There will be things, which will fundamentally change. For example, interest rates will come down and they will remain low for a long period of time. That will be a big change. We have been talking about it for months now. And it will be experienced for the first time in 2017. Also, I feel that, the kind we have been talking about it for a while. We have seen a part of it getting reflected in the investment performance as well. The small cap and the mid cap, the racy part of the market, a lot of it became very exuberant. Things have, calmed down, and there could be, worse ahead for them before things start looking up. So getting back to your basic principles, you have to diversify, you have to invest your long-term money, and you have to invest regularly, the money which you are unlikely to need for a few years. Be methodical about your investment. Don't get perturbed by, big moves in the market in a brief period of time. So just reminding yourself, having a plan and reminding yourself of this key principle and keeping it very simple, it will be very important. And 2017, the scale of noise will be such that you will be forced to think hard about, are you on track? Is it fine? Is it okay? And only a belief and conviction in what you have thought through it will bring about, calm in your attitude.
So what we're going to do this week is we're going to give you funds to invest in for 2017. I'm going to start off with the equity multi-cap funds. So what this basically means is that these funds can invest right across the market without being restricted to any one particular part of the market. And these are the top funds to invest in this year: the ICICI Prudential Value Discovery, Franklin India High Growth Companies, the Birla Sun Life Equity, and the SBI Magnum Multi-Cap Fund. Dhirendra, you've picked 4 funds instead of the normal 3 that you pick. And the interesting thing about these funds is that none of them, Value Discovery was on the list last year, but the others were not. Value Discovery tops the list this year. Tell us why you believe this is a great fund to hold on to.
No, one is that it has navigated its change in scale very, very nicely. It still remains fairly focused on the strategy it was pursuing. It is little constrained portfolio. Earlier, it was a mid cap based on the capitalization of the portfolio, so it has moved up on that scale. But despite that, I think a portfolio of 40 stocks, a belief in what it is supposed to do, and being a consistent performer. And when I look at the period in which the market struggles and this fund sails better than most others, its orientation, it may not be that deep value of fund as it used to be a couple of years back, but keeping away from the whole attitude of not being in very high quality portfolio and not necessarily expensive stocks, or avoiding expensive stocks altogether. This has come in. This comes in very handy, and this actually provides the good cushion against downside, which I expect that 2017 is not going to be a easy might turn out to be a difficult year. So with ups and downs, its ability to navigate well with a high quality portfolio, that's the reason.
All right, so this is our multi-cap pick for 2017. Right on top is the ICICI Prudential Value Discovery. The Franklin India High Growth Companies comes in next, and the Birla Sun Life Equity Fund, SBI Magnum Multi-Cap Fund. This has been picked for 2017. So if you're making a fresh investment, you should invest in these funds. If you have running SIPs, don't stop them. This is not a reason to stop and switch. If you have running SIPs and they're good 4- or 5-star funds, hold on to them. If you have questions about your funds, write to us and we'll tell you what to do. Let's also look at the large cap funds. Mirae Asset India Opportunities tops our list this year. SBI Blue Chip Fund, the Birla Sun Life Top 100, and the Quantum Long-Term Equity Fund. Again, Dhirendra, you've picked 4 funds, and I'm very interested in the fact that Quantum Long-Term Equity has made it to your list. We had a moment of doubt with this fund where you felt that the lower charges weren't really translating into better returns. Have you changed your mind about that?
No, this fund definitely reflects a conviction in what it says. Lower cost definitely is a consistent advantage for this fund. But that lower advantage of this fund has been marginalized, because now you get that advantage. For example, the ICICI Prudential Value Discovery has lower expenses than Quantum Long-Term Equity Fund in the direct plan. Of course, Quantum Long-Term Equity Fund is sold only direct, and you have the 1.25% expense ratio. But here, because of the scale of the fund, it has actually come down at lower than 1%. So that advantage is that advantage will prevail for this fund. But despite that, if you look at it, it's a changed classification. 2 funds in this category, which we used to recommend earlier as a multi-cap fund, they now figure in our large cap category. So there is a migration because of their underlying portfolio. Mirae Asset India Opportunity Fund used to be a multi-cap fund. Likewise, Quantum Long-Term Equity Fund, because of their gradual shift to large caps and remaining there. So that's the reason. And among the large caps, which is also filled with all kind of index funds as well in our category of large caps, I find that these funds have really proved their mettle. And this is based on their 3-year performance among large cap, and being consistently well, providing superior risk-adjusted performance. And the outlook for large cap for now, because large caps have been relatively out of favor. We have seen that the peripheral part of the market has been the high performing part of the market. I feel that the big bets in these large cap funds, if they fructify, if we see an economic turnaround, then these funds can well can well be the likes of the mid caps and the small caps of 2015 and 2016.
Let's take a look first at the mid-cap list for 2017. The Mirae Asset Emerging Fund, Emerging Blue Chip Fund, the Principal Emerging Blue Chip Fund, the UTI Mid-Cap Fund, and the Franklin India Prima Fund. Dhirendra, word of advice for anybody investing in mid-caps for this year?
Yes, don't expect the kind of return that you got in 2016. Also, a good part of your 2016 return from these funds got wiped out in the last 1.5 months. But at the same time, if you are looking at, great return from your portfolio over the next 5-7 years, and you could be methodical with your investment, if you're going to, if you're looking, if you want to derive substantially higher return, and you have the stomach, you have the appetite, you have the resilience, then invest in them with great discipline. I have chosen these funds with great, I've brought in rigor of choosing a fund which has been through a full market cycle. In fact, more than a full market cycle. So if you look at these funds, most of them have been through 5-7 year cycle. And they have seen a good part of a falling market and a rising market, and it's their ability to do well across cycle. And for most investors, who come into mutual fund, they get extremely perturbed by big decline in value as it happened. We saw the massive redemption from the mid caps and the small caps and the other, performing sector funds or other segment of the fund which were performing before 2008. When you witness a 50, 60, 70% decline in value, of course, I don't visualize that we will have that kind of market, but you never know. But if you are faced with such a situation, these are the kind of fund which you should stick to and continue investing as well.
So these are the funds to stick to even in that choppy market, provided you have a long-term horizon. So don't look at it over the next 1 year and then write back to us and say that you're unhappy with the returns. We're giving it to you with a caveat that you're going to have a long-term horizon, and it's going to be a choppy 1 year. Here's the list of mid-cap funds: the Mirae Asset Emerging Blue Chip, the Principal Emerging Blue Chip Fund, UTI Mid Cap, and the Franklin India Prima Fund. Also, small cap funds for 2017. The DSP BlackRock Micro Cap Fund, the Franklin India Smaller Companies, the Reliance Small Cap Fund, and the SBI Mid and Small Cap Fund. Dhirendra, again, for small caps, and we've seen this happen whenever the market has seen a little bit of nervousness or has reacted to an announcement that's come from the government, it is this set of stocks that have taken the largest beating. You expect that to continue through 2017, at least in the first half?
Yes, I expect more than, there is a possibility that this can linger for a long period of time. And if investors, here I feel that the small cap funds being recommended, they add significant value because the part of the market which actually crumbles, the funds or the stocks in these portfolios, they fall substantially. But they are not necessarily poor businesses. And I think the fund managers have done an excellent job of adding significant value with their selectivity. The small cap universe listed in the Indian market is very large. And when I look at the small cap universe invested by mutual fund, that doesn't go beyond 200 to 250 stocks. So that itself adds a great filter. Besides that, most funds are sticking to their stated strategy. 4 or 5 years back, fund managers used to give a very vague definition of what they will be doing, and then they used to drift. No longer. So as they stick to what they set out to do, what they tell their investors, they remain small cap or they remain micro cap. And investors are able to buy it at far lower value. So I think the rewards of sticking to your plan and your ability to withstand big decline in value, big fall in your investment value, will translate into substantially higher return. And that is what we witnessed in 2016-17. When you look at most time period, the return from these funds on an average, I am referring to the median and the average, sometimes used to be 2.5 times more than the large caps. So if you are looking forward to do, and this kind of return can be made only when you continue investing in a poor market. When the rewards are basically the rewards for your your bravery. You should keep that in mind.
We'll take a quick break. We'll come back on the other side. Remember, you have to still save on tax. So top tax savers, and for the first time investors, top balanced funds. Don't go anywhere. Welcome back. You're watching Investors Guide. A very happy new year to you and your families. We're talking about the best funds that you should be investing in 2017. Remember, if you have SIPs, then there's no technical need for you to switch out of them into these funds. This is for anyone who's buying a fresh fund in 2017. Let's take a look at the tax savers. These are the aggressive tax savers for 2017. Dhirendra, you've picked out Reliance Tax Saver and the Birla Sun Life Tax Relief 96. These are the same funds that you picked last year. They still hold your confidence?
Absolutely, and they performed. And one should anyway not be looking at 1 year performance, but they did well. They retained their character. Why they are aggressive is that over 50% allocation they have maintained to smaller companies and mid-sized companies, and that complexion still remains. Looking at the return differential, they have also proved to be reasonably rewarding. So they remain good fund. They retain their aggressive posture in their portfolio. So that's why no change.
No changes there for the aggressive tax savers. So remember, if you have to save on tax, these are possibly the best way to do it. They are most efficient right now in our entire system. So use the tax savers. If you're an aggressive investor and you're willing to take a little bit of risk for better returns, then you use the aggressive funds that are on your screen. If you're a conservative investor, then these are conservative tax savers for 2017, the Axis Long-Term Equity and the DSP BlackRock Tax Saver Fund. The DSP BlackRock Tax Saver, Dhirendra, has replaced Franklin India Tax Shield. Axis remains as part of our list from last year. Tell us why you believe this is a good fund.
The equity fund that, DSP BlackRock are making a comeback. Till about a year and a half back, they were not getting it right very often. And of late, they are getting it right, and that shows in numbers. And these funds actually, many of the equity funds, including this tax-saving fund, they were actually landing in the middle. They were middling performers. Now they are on the forefront. So that's why this, and it remains a large cap portfolio, and that is why it substitutes Franklin Tax Shield.
So these are the funds on your screen right now. These are the conservative tax savers that you should be using in 2017 if you are investing to save tax and you're not a very aggressive investor. On your screen, Axis Long-Term Equity and the DSP BlackRock Tax Saver Fund. Now, this is the interesting part, balanced funds. Balanced funds are ideal for investors who are investing for the first time. They're also ideal for someone who doesn't want too much volatility in your portfolio. You don't want too much management of your funds, especially senior citizens. Dhirendra has picked out balanced funds for 2017. There's the ICICI Prudential Balanced Fund, the SBI Magnum Balanced Fund, HDFC Balanced, and Tata Balanced. Dhirendra, first of all, obviously, in the year that we're looking at right now, in 2017, with the kind of volatility that we're going to expect in the market, balanced funds are an ideal way to go if I'm a conservative investor, aren't they?
They are always an ideal way for anybody who is getting started. But I think in 2017, the kind of year that I visualize, they are more than an ideal way, because they will be a big beneficiary of the ups and downs in the market. The ability of these balanced funds to rebalance on a daily basis will translate into superior performance even as compared to a large cap fund or a multi cap fund. If we end, if 2017 is going to be a year where we end up not going anywhere on the broad market, then balanced funds will actually give you close to a double-digit return, which will entirely be a reward of their ability to rebalance, because when equity goes up, they sell equity and buy the fixed income, and doing it on a daily basis in a market which is not going anywhere and very with big ups and downs, they can be a key beneficiary. So I think even aggressive, moderately risk-assuming investors, if they are getting started, they should stick to, or if you have a large sum of money to be invested, spread your money in balanced fund. That should prove to be more rewarding.
So remember, balanced funds that you're seeing on your screen right now are ideal for the next 1 year because we're expecting some volatility. So if you're a senior citizen, and one of the things to remember is that if you've been depending up till now on fixed deposits to generate an income, that interest rate is likely to come down. You will have to diversify. You will have to pick up some equity. A balanced fund is a good way to go. I'm going to give you a recap of the funds that we're talking about. The ICICI Prudential Balanced Fund, the SBI Magnum Balanced, HDFC Balanced, and the Tata Balanced Funds. If you have any questions about the funds that you've heard about on this show, you want the list, write to us. Our email ID is at the bottom of your screen, and someone from our team will send you a copy of this entire list in your email inbox. All right, the last set of funds are the income funds and the short-term debt funds. I'm going to run that list onto our screen right now. The ICICI Prudential Long-Term Fund, UTI Dynamic, Axis Dynamic Bond, the Birla Sun Life Dynamic Bond. These are our income funds. The thing to remember, Dhirendra, is that, like you said in the beginning of the show, we are going to see a world where our interest rates are going to come down. It's something that we're not used to as Indians. We've gotten used to 7, 8, in some cases 9% coming out of some of our fixed income investments. A new world will mean relying more on debt funds for the short term. Tell us how we should be using debt funds and how we should be battling this dropping interest rate.
One is that you can do very limited things. You're dropping interest rates coming down, And if corresponding inflation for you, and inflation will also come down. But the key point is that will an individual's inflation come down? Will your actual income, your dependence on income, will you be able to manage with lower income from your deposits or your fixed income investment? I don't think so. So in that situation, you will be left with no choice but to, either settle with lower income, or or if you're lucky to have a larger capital base, then invest a part of your money in equity so that it can supplement your capital needs year on year. You can invest more in fixed income as your equity goes up. So this is the only way out. But fortunately, interest rates may come down gradually, even further in the coming year. So this dynamic bond fund could be a big beneficiary and a one-time beneficiary of this interest rates coming down. So invest in these funds. These funds will give you double-digit return. That will be a happy situation as compared to 7.5%. If you are holding it for a longer period of time, the tax efficiency might also add to your advantage. And after that, in 2-3 years' time, you will have to work towards moving your money, a part of your money, into equity which can supplement your income requirement. Think of a situation that savings bank account, savings bank rate in which is 4% at the least in most banks today. If it comes down to 2%, and the guaranteed, the small savings rate coming down to 6.5%, they are well on their way in that direction. So many investors who are used to yielding 8 to 9% from their fixed income investment, and that is how they support their livelihood or their need for income in their retirement, they will be in for a big surprise. They will actually find that a third of their income has disappeared with this rate cut, and that they need to prepare for. And these dynamic bond funds can actually help them prepare for that over the next 1.5 year, or maybe 2.5 years, and then they have to definitely methodically move a part of their money into equity.
All right, let's also take you through the short-term debt funds that Dhirendra recommends for this year. The Birla Sun Life Short-Term Opportunities Fund, HDFC Short-Term, the DHFL Pramerica Low Duration Fund, and the Franklin India Ultra Short-Term Fund. Dhirendra, obviously, in most cases, it will be beneficial to investors in any of these funds to pick the direct option while they're making investments. Would you recommend that everyone use the direct option this year onwards?
Absolutely. Fixed income, the direct option, and the regular plan return is becoming quite meaningful. It might look, 0.5% difference, but 0.5% in relation to what? If you were earning, 10% and the return from the direct plan was 10% and the regular plan was 9.5%, it was 1/20th of the return. But today, if the return comes down to 7%, and if you earn 7.5%, it becomes meaningful. In many cases, it could be 10% more return in just 1 year. So direct plan in fixed income will become more relevant, and more so for this. So there will be a huge reward for all those people who need that money who badly need that money. A 10% compromise of your return on a small return base, expenses become very glaring. So every investor should consider doing it himself if he is able to choose the fund. And these funds could be a good parking ground for your money, which you need in 1.5 years' time.
Well, that's a wrap on Investors Guide. Thank you so much for watching. I wish you a very happy new year again. Stay with us as we continue to give you advice.